about the requirements for the business plan that they'll be requesting. So then in lending, we have what's called the 5 C's. And the 5 C's are credit, cash, collateral, cosigner, and character. So these, for example, when I'm putting together a loan package to submit to our credit committee, I have to make sure that I gather all of this information and put it together to be able to submit it to our underwriting team so that they can ultimately make a decision on whether they want to fund the project of the client that I'm working with. So I'll go through each one and why they're important or how lenders look at these. So we'll start off with credit. So credit is when someone lends you money and you pay them back with interest. They've extended you credit. Your credit report has all of your financial history on it or your lending history on it. So it shows most, if not all, your credit cards, any other loans you've had, whether they're student loans or personal loans. If you have a mortgage, that information will be reporting on the credit report. And it also has any derogatory information. So that can include, like, if you ever declared bankruptcy, lenders will be able to see that on your credit report, or any collections that are under your name. So the reason that lenders look at the credit is because they want to see, a good way to think about it is your credit report is your resume. They want to see how you've handled the money that you've been lent and whether or not you were able to manage it responsibly. And the credit report is usually a good indicator for them to determine how you've been with other credit in your past. So we have this here about why credit's important. So personally, your credit's important because it helps you obtain a mortgage to buy a home, to finance your car. Some jobs, when you're applying, look at your credit. But for your business, your credit also can help you get funding to increase your capacity or to buy any equipment you need, any cushion you might need if your business is seasonal. And especially as a business owner, most lenders tend to rely on your personal credit at first, just because business credit is a little more difficult to develop. It takes a lot more work and it takes a lot more time for you to start building your business credit. So when you're initially looking for financing, lenders will tend to rely on your personal credit history. So we always advise our clients to make sure they start working on that first before transitioning to building the business credit. So when we go over our clients' credit with them, we advise them on these little tidbits on how to make sure that they're managing their credit. So the biggest thing we always advise them is to make sure they're paying all of their lines on time. The biggest factor in calculating the FICO score is your payment history. So if you miss one payment, it can really affect your credit score. So this is something that we really stress to our clients. Even, like, for example, for credit cards, even if you can only pay the minimum, it's best to do that than to miss the payment. So making sure that your payment history is always on time is really important for your credit report. Another key thing are the balances you owe. So we always encourage business owners to make sure that by the time the credit card company is reporting to the bureaus, that their balances on the cards are between 30 to 50% of the credit limit. The higher you get to the credit limit, the more it negatively affects your score because it's showing, sometimes it can show that there's poor management. So you want to make sure that you're keeping those balances as low as possible. The other thing are diversifying your trade lines. So on credit reports, the two main trade lines are revolving lines, which are your credit cards or lines of credit, and then the installments. So those are usually lump sum payments like loans or your mortgage, for example, that you're making a monthly repayment back. So making sure you're having or you're showing experience with these two lines is also helpful and beneficial for your credit report. If you do have high balances, we always encourage our clients to make sure that they're working to pay them down one by one, especially if they're in a cash-strapped situation. And we always suggest starting off with the one with the highest interest rate and just making sure that they're working to decrease those balances as best as they can. We also want everyone to be as proactive as possible in checking their credit report. So we know that there are errors that can occur. even like, especially with fraud now, with the increase of the internet. So we always stress to make sure that you're on top of your credit report, and making sure that at least everything that's on there is reporting accurately. So by the time that you are going to seek financing, you'll be knowledgeable in talking to your banker or your loan consultant or loan operator and knowing like what information is on your credit report. So if you do find that you're in a situation where your credit's not so great, these are some steps in beginning to repair it. So making sure you're reviewing the credit report. On the next slide, it has some more information or tools. So I'm just going to go back down on the sixth bullet. There's a neat tool called annualcreditreport.com. This website allows you to pull your report once a year from all 3 bureaus for free. And it's a nice tool. It doesn't give you your score, but it does give you all the information that's reporting on Equifax, Experian, and TransUnion. And it's a good tool to at least review and make sure that everything on your report is accurate. So we do always lead people to that site if they're unsure of what their history looks like. But you want to start off by reviewing it. If there are any inaccuracies, you want to be proactive in disputing them or talking to the creditors and trying to come to a settlement on any accounts that are negative. And then we tend to work with clients who are facing severe credit challenges. So when they are starting to rebuild their credit, we always encourage opening a secured credit card to start rebuilding that history and giving them the tools they need to start working with that credit card, so that they can eventually graduate to an unsecured card and start rebuilding their history from there as well. So these are the 3 agencies that lenders look at. Not every lender looks at all of these reports. For example, at ACCION, we only look at our client's Equifax report. So if you are ever looking for financing and you know that the information is different on these 3 reports, it's definitely a good question to ask the bank you're working with or the loan processor person you're working with, which bureau they pull your information from. So the next C of lending is cash. So cash flow is huge in putting together a loan application. And the big thing, the main reason is lenders want to make sure you can pay the loan back. They want to make sure that they're not extending you credit that is going, one, to harm your cash flow or to harm you, but also they want to make sure that they can get their money back to re-lend back out to the community. So generally some good information that they'll ask for are definitely your bank statements. So they need some kind of proof that you have business sales, or even if you have additional income, if you work part-time, or if you have any additional household income. These are definitely are seen as strengths when putting together a loan application. With the bank account, we're going to go a little bit more into it, but it's really important to make sure that you're separating your personal finances and your business finances. And I have a whole slide on that, so I'll go into more detail. If you're not depositing all of so if you're a cash-based business, for example, and you're not depositing everything into the account, making sure that you're keeping good bookkeeping is important. And lenders can look at any receipts you have or journals that are showing your cash flow records. So when I'm talking to a client and I ask them how their business is doing, 99% of the time they tell me that their business is profitable, which is helpful to know, but it's not really the answer I look for as a loan consultant. And it's not always the most important number that I'm looking for, which businesses tend to think their profit is the most important part of their business. As a lender, we also look at your cash at the end of each month. We generally call this cash cushion, and this number is important because it shows us that you're able to manage your account or your income and expenses well, that you have some cushion at the end of each month in case of an emergency. So things can happen and unexpected things can happen, and it's always difficult as a lender when somebody's coming to you with an emergency because they're not able to cover themselves because of a cash issue. So if you are running into generally if there's some kind of issue with the cash that calls for a riskier loan application, so you want to make sure that you're presenting your business as less showing as less risk as possible. So definitely making sure that you're keeping or monitoring how your cash is flowing in and out of your business at the end of each month is really important in putting together a loan application. Okay, so the separating business expenses and personal expenses. This is the number one thing we see at ACCION, or at least I see with my clients. We can work with these types of businesses, and we generally see this as a form of informality. We have clients who, for example, do have a business account, but they're still using this one business account to run all their personal expenses and business expenses in. When we see this, we always encourage our clients to separate it for two main reasons. One, it's not giving you an accurate description of how your business is doing. So I run into many cases where I'll ask one of my clients, like how much is your business grossing monthly? And they'll tell me they're grossing like $22,000 to $25,000 monthly. But when I start looking through their bank statements, that number is not accurate. It might look like that on their deposits summary, their withdrawal summary. But if I'm really analyzing it and seeing where the money's come from, sometimes they're transferring money back and forth, or they're getting refunds, or what it may be. It's not really reporting an accurate depiction of how the business is doing. So you want to make sure that for your own knowledge, especially when you're going to a lender, they're definitely going to ask you that, and it's better to be. It looks better if you have an accurate as possible number of how the business is faring. The other issue, or the other main reason, is that in the long run, it will make out a smoother process when you're filing your taxes or working with the IRS. We see this happen quite a bit, where people, because they're mixing so much of their finances, they're not getting all the deductions that are valid, or they're claiming things that shouldn't be deductible, and they can run into trouble with the IRS. So you want to try and prevent that as best as possible. And in general, when you are applying for financing, when you have this information separated, it just makes it for a smoother process. So when I work with people who are mixing it a lot, their personal business expenses, it takes me a lot longer to go through their bank statements, which is also going to prolong the processing time for their loan application. If I'm working with somebody, for example, who's doing a lot better job on it and is actually just using their business account for business expenses, it takes me a lot less time, and I have a lot less questions for them when I'm putting their loan package together, which will usually translate to a faster processing time and a faster decision. So definitely keep that in mind when you're preparing to look for financing. And then savings. Like at ACCION, for example, we don't always ask to see savings, but if we find that there's some type of general weakness in a loan application, we check in with our clients to see if they do have a savings, just because it could be an added strength. That's from a loan packaging view, but from a business view, having a savings or extra cash is good, and with that whole idea of the cash flow at the end of each month. So it's good for any unexpected things that might happen, whether like you're a transportation business and you need some kind of repairs, or if your business is seasonal, like we work with a lot of landscapers, for example. So we know that they're really busy between maybe the months of May and October, but then they have a severe decrease in their cash from November to March. So just having this extra cushion is good for you as a business, but also a really big strength when you're seeking financing. So the next thing that lenders look at is collateral and cosigners. So cosigners are somebody who, depending on the lender, somebody who's not involved in your business and has their own source of income. And they're somebody who is pledging to take over any payments. And in the event that for whatever reason you're not able to make those payments anymore. Collateral is any type of asset that can be used to secure a loan. At ACCION, for example, we only take like large equipment and either like a vehicle as collateral, but there are banks, for example, that can take like your receivables as collateral, your houses. These two, the cosigner and collateral is just a way to secure the loan. Every lender is different in their policy for cosigners and collateral. So this is definitely something that you want to come prepared to talk about when you start to shop around to find a lender. Again, like not everybody requires them, or depending on, they're usually also good to mitigate any type of risk. So let's say, for example, for like a seasonal business, like lenders know that this business is not going to make as much money in the winter as in the summer, so they need some type of security to know that they're still going to get the payment during those winter months, and they might ask for either of these options. Some lenders ask for both. This is definitely something when you do go to either different banks or other nonprofit microlenders that you come prepared to discuss. Just so you know what their requirements for these two securities are. So getting loan ready. This is just basically a summary of everything we just went through. So they want to make sure that you come with a well thought out business plan, especially that business plan that talks about what you're going to use the funds that you're asking for and how that's going to help your business. Know your personal credit report history. So it's generally a good thing to know your credit score. And if there is any derogatory information, it's best to be really upfront about it. I've had cases from bank referrals, for example, where they'll refer somebody to me because somebody wasn't totally honest about the information that was on their credit report that they ended up seeing after, and their underwriters don't want to fund that business anymore. So honesty is always the best method, especially when it comes to your credit. And also you want to prevent any unnecessary inquiries on your credit report. So if you know that there's something on there, it's best to bring that up to the lender as soon as you can before they pull your credit, because if we pull it and we see it and we can't fund you, then now you have an inquiry on your credit report that, one, brings down your score, but two, that is also there for 2 years. So when you're looking for financing, lenders can see that you've been shopping around for other financing. That can also sometimes increase the level of risk of a loan application. You want to make sure your record keeping is straightforward, and that you're bringing that information with you, whether it's your bank statements, your tax returns, making sure that information is clear for the lender to ensure a smoother process, but also so that they can have a better idea of the loan amount they'll be able to lend to you. You can answer any questions about any cosigner or collateral options. And then again, banks in particular are really huge in wanting to know why you need this money. Like it's always really frustrating when people come to us and ask us for $50,000, and when we ask them why, they don't know, they're not sure, or they have really broad answers. So you want to make sure you do your research, and if you can, come with quotes. If you want to buy equipment, that's always really helpful, and it shows us that you're prepared. And it also, for the 5th C, it also talks a lot about your character. If you're prepared and you know what you're financing for and why and how it's going to help, banks or lending institutions tend to feel a little more comfortable in going forward with that loan application. So financing options for businesses. This is a credit continuing financing options for business owners. And it generally correlates with the stage a business is in. So for example, on the left side of the microloans, with friends, family, and crowdfunding credit cards, we tend to see these methods of financing more typical for earlier stage businesses, whether they're startups or operating for less than 6 months or less than 2 years, because of the time of business they're in. Their financing options sometimes are limited, so they tend to rely on these two. You also have the option of microloans, which is the category ACCION falls in. ACCION isn't the only nonprofit microlender. There, in Boston at least, there are others like LIST and Dorchester Bay. the CWE. There are other organizations that do microloans for small businesses. And then the more you grow as a business and formalize your credit or formalize your finances, you have the options of bank loans or SBA loans, and then equity and investments. So generally for banks, we see that they need an established business for them is one that has at least 2 years of tax returns. So businesses operating less than 2 years tend to fall within the microloan stage. Alternative finance, so this just talks a little bit more about microloans and other financing that there is. At ACCION, ACCION has actually been the first organization that pioneered online lending. So, for example, we have about 5 offices, one in Massachusetts, one in New York, three in Florida. Yes. And all the other states that we cover, we don't have offices in, we do online lending. So we have a team of loan consultants that work remotely and that lend to businesses that we don't have an on-the-ground presence in. With this, we also see that sometimes our clients can fall into trouble with other online lenders that are not either CDFIs or SBA certified, and we tend to call these like shark loans. And these, we want to make sure that you are aware of spotting these lenders out. And the big thing in knowing whether like they're a shark lender is their repayment history or their repayment model. We've worked with clients who have had a hard time getting loans, even with ACCION, because they take out a loan from one of these lenders, and they're paying $200 daily as a repayment for a $5,000 loan, for example. So you want to make sure that you're being aware that you're not really falling into these, just because it can really harm your cash flow. They might offer like very low interest rates. Sometimes they advertise as low as 3 or 4%. But in reality, that's basically a daily interest rate. So the APR for the full years, usually we see between 400 to 500% in actuality. So making sure that you're looking at like their payment structures, their interest rates. Generally, it's better to go through somebody who's SBA certified because they've been vetted through the federal government, or a CDFI as an organization that is community-based and also federally regulated. So just keep an eye out for these. They're very aggressive, but just knowing that you have more reliable options. I know like Interise also has their own network of financing that they can guide you to. So just making sure you're tapping into those resources before going to these. So ACCION, you also have ACCION as an option if you ever find, as Laura Lee said earlier, if you ever need like any type of infusion of capital to purchase equipment or inventory or working capital. We also do loans for business owners. Our loans range from $1,000 to $250,000. And we have this beautiful flyer that's just for Interise alumni, which is great. So first, for our microloans and small business loans, let me backtrack, excuse me. We have 3 main programs. We have a micro lending program, a small business lending program, and then we have an SBA loan called Community Advantage. Our micro loan and small business programs go up to $50,000. And they can be used for a variety of loan purposes. The only thing that ACCION can't fund is any type of real estate purchase or land purchase. Otherwise, we're very flexible in the funding loan purpose. Excuse me. For credit requirements, we just ask that you have a credit score of 575 to pre-qualify. We do work with business owners who've had bankruptcies, so long as they've been discharged more than a year ago. And then depending on the loan amount, we try to make the process as smooth as possible for you. So any loans up to $12K, for example, we only request your last 3 months of bank statements to analyze your cash flow. And then anything 15 and up is when we'll start asking for tax returns. Loans under $25,000 don't have to be secured with the collateral and co-signers that we talked about earlier, but anything over $25,000 does need some type of security, usually in the form of collateral is what our underwriters tend to look for. Then we have our SBA loan. It's an SBA 7A. It's from 50,000 to 250,000, and it's also very flexible in its loan purpose. I think for this one, though, you can purchase land, for example. The big thing with the SBA loan, the credit's a little different. Their minimum credit score is 600. And then the other big thing with credit is just making sure you don't have any defaults on any federal debt in your credit history, so that since an SBA loan, you have to be compliant with any other SBA funding you've had in the past. With processing time, the microloan and small business loan it's about 1 to 2 weeks. We have an average 9-day turnaround. And then the SBA loan is a little bit longer because we have to send it out to the SBA for final approval. And that's usually where the processing time lengthens a little bit, but it's generally between 45 to 60 days. All of our loans don't have any prepayment penalties. So you can, if you get a loan out for, let's say, 60 months, if you pay it off in 36, that you wouldn't face a penalty for that. And then our interest rates are fixed interest rates. So for our micro lending and small business lending programs, our interest rates are between 8.99 to 15.99. And then the SBA loan is market based. And I believe the last time I spoke to a loan consultant, they said it was at 8.5%. It's usually prime plus 4.25. So these are generally the programs we offer. This is my contact information. So I work with businesses, again, in Massachusetts, Rhode Island, Maine, Connecticut, New Hampshire. But we also have an intake center for any of the other states that I didn't just mention, that are also there to answer any questions you might have about the loan process. But anybody can feel free to contact me. And if you're in a state that I don't cover, I would be more than happy to connect you with the loan consultant that does cover your state.
Awesome. Thank you so much, Melissa. This was, just great information, a lot of information to kind of digest, but I think it offers a really wonderful starting point for people who are beginning to think about lending. So I think that you answered this. There was a question that came up, just kind of what constitutes a micro loan. So is it purely just the size of the loan, or is there some other consideration for what qualifies a micro loan?
Yeah, generally the size. So I think generally in the industry, it's up to $50,000. So for example, like we've worked with we get a lot of bank referrals. We have partnerships with banks so they send us people who generally can't get funding through them because of some type of like issue. Sometimes it's loan amount. So I've even worked with somebody who's had great credit, but they only needed $14,000, for example. And for banks, that's too little. They lend at much larger amounts. So generally, generally the microloan is just the loan amount, but it's up to $50,000.
Okay.
Yeah.
Great. Thank you. So those of you on the webinar, please feel free to chat in some questions just after seeing that information, or if there's any, if you're maybe just starting this process, or if you're somewhere along, farther along in the lending process, if you have specific questions about what you're preparing or what you should be looking for, please take advantage of Melissa's expertise here. One question that I have, just while people are thinking, Melissa, is kind of what are some ways to kind of assess these different financing options and determine what's best for each individual business owner in business? Yeah.
So generally, we advise business owners to start at their bank. So to go into the bank that they have an account with, even if you think that you're not going to get approved from them, banks work with other organizations that they can possibly refer you to, and the referral is usually another strength, just because you're coming from a trusted, like somebody from ACCION, for example, that comes in through Interise, for example. There's a level of the level of risk drops somewhat because we know that Interise is a trusted organization, and that they're not sending us somebody that is not fraudulent, for example. But banks are good to start with, one, so you know their requirements, and if you ever do want to go back to your bank for financing, you know what they're looking for later down the line, and you can start working on it. But they can refer you to other financing options that are trusted and not something that you can just Google and get run into trouble with that, like shark lenders, for example.
Great, that's helpful. So I do have a question. This business owner is asking if it's necessary to have a financial person, to attend a meeting with the business owner. If the business owner doesn't necessarily, consider him or herself a financial expert or kind of the financial know-how of the business.
Mm-hmm. I don't think it's a requirement. It's generally better if you know about your finances. I mean, I last week, for example, worked with a business owner who had her CPA on the phone while I was working with her. But especially as depending on how long you've been operating, it's not really quite. I mean, depending on the loan, I think with banks, the larger loan that you're asking, they do want you to work with somebody like a lawyer or a CPA. Depending on how large your business is. But if you're like a smaller business, it's generally not something that's required.
Mm-hmm. Mm-hmm. Can you think of questions maybe that you would ask that would require that kind of deep financial knowledge, or that may not? Maybe you have examples of questions that you ask that the business owner really can field on their own.
Like with the financial advisor?
Mm-hmm.
Let's see. I think mainly for the taxes, especially because I don't do my taxes, for example, so I'm not like very knowledgeable in that. But when we're looking at a business owner's tax return, sometimes because they have somebody else doing it as well, I think in that situation it would be helpful to have the person who did your taxes, just because we can spot things that maybe the business owner doesn't know about, like depreciation, for example. Lenders want to know what it is and the depreciation that you're claiming. So I think the financial person would be helpful in that instance, and knowing, like, finding answers like that, or I know there's like a category called other expenses. Like, what are those other expenses? Because every CPA has like their own way in reporting your financial information. So that would be helpful. Or even like if there's a discrepancy between your bank statements and your tax returns, that's generally just like a reporting, like a depositing issue, but that's also something that a financial advisor might be useful for in explaining.
Great. Thanks. There's another question. So you said cash is important. At what point should a business owner look for a loan if they do have cash?
Yeah, that's generally up to the business owner. If you want to give yourself time, right? Like, it's better to go to a lender with some, especially with some time between the application to when you actually need the financing. It's always a little like frustrating when somebody's coming to you. Let's say they need like this piece of equipment next week. They need funding for that equipment next week. That's always a little difficult to work with. Especially with like the SBA, for example, like their processing time is a lot longer. So you're going to definitely run into trouble with that, or even like some banks that don't have express products and you have to go through a full doc process. So just making sure you're planning out and giving yourself time from when you're inquiring about the financing to when you actually need the funds is a good general rule of thumb.
Yeah, I think that's a great question, because I do remember a conversation with another alum who was kind of realizing the importance of debt. And, he was always fairly comfortable with cash and was just kind of operating from that for years. And then reached a point where he sort of started to understand the importance of debt and how you can strategically use loans or other forms of financing even if you do have the cash. So I do think, and I'm sure it depends on the business, it depends on growth goals, it depends on a lot of things. But I think that that's a great question and something to think about. Even if you do have cash, and if you're operating comfortably at the moment, you know, with cash, where is it a strategic decision to enter into some kind of financing?
Right. Or even like the kind, like being strategic about the kind of debt. So again, like what you just mentioned earlier with the loan, between like a loan and versus a line of credit, for example. So I've sat on panels with bankers, for example, who talk about lines of credit being only really for like either inventory that you know you're going to run out of, or as you wait for accounts receivables. Sometimes banks don't want to lend under a line of credit unless it's one of those two options. But then like with an installment loan, for example, generally asking if there's a prepayment, especially if, like as you said, if you're okay on cash, asking about the prepayment penalty can be huge, because you're like the funding that you're asking for isn't necessary. So you always do have the option of paying it off before, but it's also reporting on your credit report. So when lenders look at it, they know you've had experience with these types of either lines or amounts of debt that you've been in, which is helpful.
Great. Cool. Yeah, a couple more questions here. What are some examples of appropriate needs for a loan? For instance, marketing costs, adding staff versus cost of a purchase, like equipment or a CRM database. This business owner says, you know, she understands that you don't want to ask for a low amount, but may need to ask for something a bit higher than you might need, almost like a contingency or a cushion, I guess.
Yeah. Yeah, if you do like generally anything that you can provide a quote for or some kind of a breakdown is helpful, whether it's like with equipment, like lenders know marketing is expensive as well. So we blend under like the marketing umbrella. So let's say, for example, like you're requesting $25,000 and you know 15,000 of that is going to go to marketing or like equipment, and 10,000 or 5,000 is going to advertising. And if you can explain what the other like $5,000 can be used for, like working capital, which is generally the term for like cushion. So long as you can break down and answer why that would be important for you to either sustain or grow your business. That's generally like what we encourage. Or even going and asking, like you're having like a range, like I need like 20 to 25,000, because that also shows flexibility. And generally also shows a lender too that if you did only get the 20,000, you were looking for 25, that you would still be able to sustain yourself with that loan amount.
Excellent. Great. Anything else from those of you listening? Okay. Great. Big thank you. And you have Melissa's contact information, which is great, as well as the intake center number. I don't know exactly where everybody is located, but you know, I think it's really helpful to have that direct line of contact. And here's one more question before we go. Can a loan be used to fund salaries for new employees?
Absolutely. We run into that a lot, and especially like nonprofit organizations that you're asking money for, like Dorchester Bay, for example, in Boston. They require one of the things that they're looking for when they're looking to fund a project is whether you plan to hire, because they want to make sure that they're creating jobs for the local economy. I definitely think that's generally like a good loan purpose. That banks or other nonprofits like to see.
That's fantastic. That's great. Is it okay to make these slides available to people on the call? I did record the presentation, so that will be posted in iConnect.
You want me to? I can send you the PowerPoint. Is it like, can you post it somewhere or?
Yeah, and I can share it directly with the people on the call, and also post it with the webinar recording in our online community.
Yep, absolutely. I can get that to you.
Cool. Well, thank you very much, Melissa. Thanks for those of you who asked questions. Always really helpful for everybody else on the line. And feel free to follow up with Melissa. Feel free to follow up with me if you have questions. And good luck. Good luck on this next stage of growth for all of you.
Absolutely. Thank you so much, everybody. Definitely feel free to contact me with any questions at any point. You can give me a call or send me an email. I'd be more than happy to answer anything for you guys.
Excellent. All right. Enjoy the rest of your afternoons, and thank you again, Melissa.
Thank you, Laura Lee. Talk soon.
All right. Bye-bye.